Es ist mir eine große Freude, Herrn Chen Zhao anzukündigen. Chen Zhao ist seit 2005 Chief Strategist der Global Investment Strategie von BCA. BCA ist ein unabhängiges Research-Institut, das sich mit makroökonomischen Research beschäftigt und gleichzeitig auch berät bezüglich der Implementierung, also bezüglich der Investmentstrategie. Es ist ein unabhängiges Unternehmen, 1949 gegründet. Chen Zhao ist seit 1992 dort tätig, war zunächst verantwortlich für die China-Investmentstrategie, anschließend für die Emerging Markets-Strategie und er hat vor seiner Karriere bei BCA als Professor an der Central University of Finance and Economics in Peking unterrichtet. Ich freue mich, dass Sie heute hier sind, Mr. Zhao, und wir sind gespannt auf Ihren Vortrag. You may sit here.
Thank you very much. Thank you for the nice introduction, even though I have no idea what you said, but I would assume that it's something nice. I work for a firm called BCA Research. I think some of you may know. For those who do not, we're independent macro research. We do market analysis. We have been around since '49. I think you mentioned emerging markets, China. That's what I did before 2005, i.e. basically I created our China publication and emerging market publications. And then since 2005, I started to write our global piece. So I've done a bit of everything. If you have a question with regard to China, emerging market, G7, anything that has a price, anything that moves around, I will guarantee you an opinion. But there will be no guarantee that will be the right one. But you're going to hear from me, that's for sure. What I will do today is to basically lay out sort of the macro stories, the key macro themes that are going to shape the global financial markets. And then I'll try to relate these themes or stories to financial markets to see how to make some money out of it, or at least how to lose a little bit less. If time allows, I will give you some very concrete investment ideas. I hope those ideas be a sort of a contrarian thought or controversial ideas. That will be my three little parts of my presentation. On the macro story, I think there are three very important themes I would like everybody to remember. Number one, if you think about the world economy, we have gone through a very unusual time. The reason I'm saying that we have gone through a very unusual time is if you think about the post-war period, most of the time, I think probably 95% of the time, the major economic blocks around the world are almost always moving in sync. It means if they have expansion, they expand together. If they have recession, they contract together. But that has not been the case for the last 5 years. Well, if you think about the United States, the US economy has been very steady since 2009. Slow, no question about it, but very steady, moving along the path of 1 to 2%. Even though we have had quite a few periods or episodes of instability concerns, such as federal debt downgrade, fiscal sequestrations, a lot of concerns, instabilities, but nonetheless, the US economy has been very steady. That's the US. Now, if you go to Europe, just think about the Eurozone growth. The Eurozone economy has made a classic double-dip recession. The first down leg took place in 2008, 2009, followed by a very brief recovery in 2010, and another down leg since 2011. So you have had a classic double-dip recession in the Eurozone. Now, if you move to China, the Chinese economy has done completely differently from everybody else. What happened? Well, if you recall, the Chinese economy has a huge acceleration in 2009 and 2010 on the back of that massive fiscal stimulus. Everybody understands that today. And the growth rate really peaked towards the end of 2010, and since then, we have had a steady deceleration that is still going on today. So Chinese economy has done a wish up and wish down. So as you can see, we have been all over the map for the last 5 years. It's completely out of sync among all the major economic blocs. The reason I mention that is I want everybody to remember this will be the first year since the recovery started 5 years ago that the world economy will have some synchronized expansion. Be careful here. I'm saying synchronized expansion. I'm not talking about synchronized boom or anything like that, because every time I mention synchronized economic expansion, people always say, Chen, you're talking about boom. Where's the boom? I said, no. Growth rate will remain to be below potential. I don't care whether you're talking about the United States, Europe, and China. Growth rate will be below potential. But nonetheless, we will have some synchronized expansion. This is very important. This is very important not only as an economist, but also as an investor. I will talk about that later on. So that's the first macro story I want everybody to remember. The second major macro theme I think is hugely important for everybody here is the fact that actually since this is the first time since the end of Second World War, the industrialized world is this close to price decline, okay? We are dealing with a realistic possibility of price deflation. Now, let me tell you this. Everybody understand some of the anecdotes, but statistically, out of 24 OECD countries, 18 of them have domestic inflation rate that is below 1%, okay? In other words, the majority of the OECD countries have domestic inflation rate that is below 1%. So if you have inflation rate that is below 1%, you really don't know. You have no clue whether you are inflating or you're deflating. Some of my colleagues said, you know, we have 0.52% inflation. I said, you sound like a nerd. You really don't know. What we know is the inflation level is extraordinarily low, okay? So I will have to comment on the Eurozone situation a little bit. If you think about the world economy, I think in the 90s, Japan was the first major industrialized country that have fallen into price decline. I think right now, the Eurozone probably will be the one that will have to be very careful here. Let me show you a few pictures here. This is basically telling you that we're having a synchronized move today. Look, this is the price inflation of Eurozone. I overlay the price inflation in Eurozone, which is the red line, over the Japanese CPI from 1990, I think Japan is 93, all the way to current. Now, the message here is if you look at the level of inflation rate in the Eurozone, we're very consistent with where the Japanese was in 95. In other words, if you look at Japan's inflation rate, Japan got into deflation in 98. 3 years earlier, the inflation rate was very low and is slowly dropping into negative territory. If you look at the Eurozone today, the behavior of pricing, the behavior of the price level is very similar to Japan. That is not really the point. The point I want to make here is that if you think about the reasons why Japan got into deflation, the reasons are very similar to what is happening today in the Eurozone. Why? If you think about Japan, Japan basically made two major policy mistakes in the 90s. Number one, the Bank of Japan basically allowed the Japanese yen to appreciate 93% between 1990 and 93. If you had a big currency appreciation on the background of a collapsed asset bubble and credit deleveraging, you are inviting deflation. There's no question in my mind. I think that's a major policy mistake that has been made by Bank of Japan, number one. Number two, if you look at the Japanese government's fiscal policy in the aftermath of the collapsed real estate bubble, what happened? They tightened the fiscal policy. If you look at a Japanese fiscal balance, it turned into surplus in 1992. So these two things basically contributed to the price decline in Japan. Of course, there's a whole range of other factors in Japan, oversaving, oversupply, demographics. We can sort of name a lot of things, but these are two policy mistakes, in my view, have greatly contributed to the Japanese price deflation. The reason I mention that is if you think about what is going on today in the Eurozone, it's very similar. It smells the same, it touches the same, it looks the same, probably they are the same. The reason I'm saying that is I think ECB basically has turned a blind eye to a very expensive euro, especially to the euro that is so expensive that is forcing the peripheral countries to internally devalue. If you look at some of the numbers, it's mind-boggling. The reason I'm saying that, if you think about the real wage growth in Spain, it dropped 28%. If you look at nominal GDP in Greece, it has been off 30%. These are depression-like adjustment that has been already taken place. This is a classic problem of devaluation or deflation. You have to choose one. It looks to me that the ECB has chosen a route of deflation instead of devaluation. That's the first thing that I'm talking about. And then if you think about the fiscal policy, the behavior of the fiscal policy is exactly the same as what happened in Japan during the early 1990s. What happened? Well, fiscal austerity. That is completely, absolutely wrong thing to do at the time of oversupply, at the time of oversaving. You are trying to fiscally tighten your policy, meaning the government sector has to save more and spend less. You are only contributing to the oversaving problems. That's another reason that is going to create price decline. So that's what I'm saying. I don't care what ECB is going to do this week. 25 basis points, 15 basis points, I don't care about that. I think the problem here is devaluation versus deflation, and I think the ECB has basically made the explicit choice that they don't want a major devaluation of the currency, and I think that's basically a key reason why the Eurozone will probably go into mild price deflation in the next year or two, okay? So the second major theme, I think it has a huge implication on bond market. I will talk about that later. The second implication is we are very close to a mild price deflation in the Eurozone. The whole industrialized world is dealing with extremely low inflation. That's the second macro theme I think everybody needs to remember, and I will talk about financial implications later on. Thirdly, the third macro theme I think is also very important, especially for financial markets, is the fact that this cycle, the recovery cycle, has turned completely flat. Let me tell you what do I mean by that. If you think about the cycles, the standard theory basically tells you every business cycle should consist of 3 stages: recovery, boom. Boom basically means the growth rate is above potential rate, and then recession. The recession is basically, it's a reoccurring process of moving from recovery to boom and back to recession. That is a classic business cycle. Well, of course, the duration of this expansion to recession is very different. Sometimes it's very short, other times are very long. For example, the longest expansion that we have ever had since the end of the Second World War was in the 1990s, because the recession in the early 90s was the savings loan in 1990, and the next recession actually is 2001. So we had about 10-year expansion during that period. But on the average, on the whole, if you calculate according to, well, actually, National Bureau of Economic Research, they are sort of the most authoritative organization to declare recession. According to their calculation, on average, a business cycle in the United States has averaged about 54 months. Okay? Let's call it 5 years. 5 years, about 60 months. Let's say plus or minus. So the average duration of a business cycle in the U.S. is about let's say 5 years. Some people actually have noticed that and saying, well, this cycle, we have already had 56 months of business cycle expansion since March 2009. If you calculate, we're already done, close to 5 years. The onset implication is that this cycle is getting very aged. This cycle is getting old. This cycle is becoming dangerous. I don't agree with that at all. The reason I think they got that story wrong is the following. If you look at this cycle, we have had enormous difficulty in making the transition from a recovery to a boom. In other words, if you look at the U.S. economy, we have been basically gliding along the path of 2 and 2.5% along the way. We have never been able to grow the economy above the potential rate. Let me show you some pictures here. Look at the first panel. The first panel basically is the GDP growth, deviation of GDP growth from its long-term potential. The shaded areas represent the so-called boom, which means that the growth rate actually is moving above potential rate. As you can see this time around, since the recovery started, we have never been able to even move towards the trend. 5 years into the recession, into the expansion phase, we are still laboring at a level that is far below potential rate. Now, there's a whole range of theory trying to explain this, you know, from Larry Summers to Paul Krugman. They're talking about secular stagflation. They're all trying to give you some fancy theory to explain this. But I think I'm a simple man. I like simple solution. I think the reason that this cycle has turned completely flat is incredibly simple. What is it? There's no re-leveraging. There's no re-leveraging in spite of the fact that we have dropped interest rate to zero. If you look at the U.S. household sector debt to GDP ratio continues to decline. It actually fallen about 25%. And today it is still going down. That's a household sector. Household sector accounts for 70% of the U.S. economy. And now if you look at the corporate sector actually, if you look at the corporate sector borrowing, the corporate sector debt, it is going up, no question about it. But if you look at the cash on the balance sheet, if you look at the very muted capital expenditure, basically you know one thing. The corporate sector has been taking on debt, not to make investment, but they are taking on debt in order to buy back shares, to benefit their shareholders, instead of making leveraged capital investment to grow the economy. So they are basically trying to optimize the capital structure by taking on more debt instead of growing the economy. Now, the problem here is, if you do not take on leverage, then your spending power, I don't care whether you're a household or you're a corporate sector, your spending power will be confined by your income. You are not going to be able to move your spending power at the level that is beyond your income growth. Now, you have to ask yourself, what will be your income growth? What will be your steady state income growth? That's very easy to answer. for any economy, I don't care whether it's German economy, American economy, or Chinese economy, the natural rate of income growth consists of two parts, labor force growth and labor productivity. In the US, labor force growth is about 1%. Productivity growth, about 1.5%. So you basically have a steady state income growth of 2.5%, and your spending will be confined by that natural rate of growth, and that is exactly what has happened over this period of so-called economic recovery. Because if you look at a PCE, personal consumption expenditure, has average growth rate has averaged about 2.1%, something like that. That's the problem. It's a lack of leverage. Okay? So if you look at this chart here, this is pretty straightforward. If you look at the second panel here, this is U.S. credit. The U.S. credit is still way below the previous peak level. Well, it's far below the previous peak level, and it's still way below the average level of the last couple of decades. Now, if you look at this, this is a global credit. Every country is going through a deleveraging cycle. Everybody is trying to reduce debt. Even Chinese economy is trying to do that. And if you look at the Eurozone credit is still contracting. So that's the picture. That's the reason why this cycle has turned completely flat. Okay? No leverage. That's the problem. Well, you can say that it's a problem, but actually there's a good side about it. But we'll talk about that later. In sum, three major macro themes I want everybody to go away, keep that in mind. Number one, we're going to see some synchronized economic expansion around the world. Number two, we are very close to generalized price decline with the possibility of the Eurozone falling into mild price deflation in a year or two. And number three, a very flat business cycle. These are the three things you need to keep in mind. Three macro stories. Now, what do these stories mean for financial market? Let me go through that. I think that's when the thing becomes really interesting. First of all, if you agree with me that we're going to see some synchronized economic expansion around the world, then corporate earnings, this is the US, corporate earnings will re-accelerate, okay? If you look at this chart here, the red line is our earnings model. Don't ask me how that is constructed. Believe me, it's always good. Now it's telling us U.S. earnings will expand, re-accelerate towards 10%. Some people saying, how possible? You're talking about flat cycle and earnings growth turned into 10%. I mean, how that possible? How this thing is this number is not possible. I said it's entirely possible. Let me go through some of the thinkings here. If you look at the U.S. corporate earnings, 40% of that come from overseas. Okay, 60% is generated by domestic economy. If you look at the breakdown of these two sources of earnings growth, the overseas earnings have been contracting. Reflect the fact that the world economy outside the U.S. has been pretty sick, pretty weak. But the U.S. domestic economy has been doing great, generating most of the earnings growth for the last, I would say, 3-4 years. Now, this year, if we see some synchronized global growth, I would bet that the overseas earnings growth, which have already collapsed to the very low level, will most likely go back to the sort of an average growth rate, which is about a 10% every year. This is not a huge assumption because you have already collapsed that level, and then you have a little rebound will take you to 10%. So 10% overseas growth, that will translate into 4 points of earnings growth, and let's just assume domestic profits will grow in line with nominal GDP in the U.S., let's say 5%. That gives you 3 points, right? So combine these two sources, we're talking about 7% earnings expansion. Now, every year, the corporate America buy back shares worth about 2 points. So you add another 2 points to your EPS, you are talking about 9% earning EPS growth. My model probably is too optimistic, about 1 point. Who cares? I think we're talking about something like 9 to 10% EPS growth. That's the very important message you want to keep in mind. Don't short the market. Now, this view here, another thing you have to keep in mind, I think probably some of you may have this question in mind. The profit margins. U.S. corporate profit margin is already at record high. How possible you grow profit even more? Would that push corporate profit margin to extremely high levels? I think that is a fair question, but it's with a very misleading information. The reason I'm saying that, again, is due to the fact that if you look at the U.S. corporate profits, 40% actually come from overseas. So you have to really properly measure the margin concept, i.e. you need to use domestic profits over domestic output. Meaning GDP is domestic national product. It's domestic. So you have to measure profit, the domestic profit over domestic GDP. If you take that recalibration, this is the picture. We are way below, the margin is way below the highs that we have reached in the 80s, in the 50s and 60s. So it's completely nonsense to say that the U.S. corporate profit has been already at a very high level. You have to make adjustment. If you look at Singapore's corporate profit over GDP ratio, it's almost at 100%. It's how possible? Well, this is a small city, and it's got a lot of companies that are listed there, and the profit is all from overseas. And of course, you got an almost absurd level. So all I'm trying to tell people is that if you look at the domestic profit over domestic output, profit margin is not excessively high. It's high, no question about it. It's not at record at all. So that's the second thing. Sorry, how to go back? Okay. Now, the third implication I want to talk about is this. If this cycle completely turned flat, as I described, I think it will continue to be very flat because no sign people want to take on more leverage. If you don't have more leverage, your growth rate will continue to be confined by your natural rate of income, which is about 2% around the world in the major industrialized world. So if the cycle turned completely flat, then you could think of a situation where there's no boom and there will be no bust either. You exchange the magnitude of recovery for duration. This cycle could go on, this expansionary phase could last a lot longer than you and I would like to believe because there's no boom. If there's no boom, there's no bust. So you have a cycle that is completely flat, and then you can stretch it out for many, many more years. Now, the question becomes very interesting now. I don't have the answer, but I would like to pose that question to you to think about it. And I have my opinion, too. It is this. In this environment, with very low inflation, the Fed is not going to do anything. The cycle is very flat, 2.5% real growth for a number of years. What should be the equilibrium PE ratio for common stocks? Should it be 13 times or should it be 20 times? That is important. If the equilibrium PE ratio is 13 times, we're already very expensive today. If equilibrium PE ratio is 20, we're still undervalued. So you have to think about this issue. You have to spend a lot of time thinking about it. I don't think I have the scientific answer, but I can share with you my gut feel. There's completely non-scientific, and you can say, Chen, this is totally nonsense. I take that. Now, the calculation is this. In this flat world, in this flat cycle, you first of all have to assume a terminal value of risk-free rate. That's your anchor. In my view, that risk-free rate could be at around 3%, okay? i.e. Treasury bonds, 10-year Treasury bond should yield about 3%. I don't know whether it's going to be this year, next year, but it's the terminal value. At the end of this business cycle expansion, maybe a couple of years down the road, let's say 3%, that being equilibrium. And then if you think about equity risk premium, in the 90s, that is basically the earnings yield exceeding the risk-free rate. That is basically called equity risk premium. In the 90s, the average equity risk premium is about 100 basis points. In 2000s, last decade, the average risk premium for equities was about 200 basis points. During 2011, 2012, the equity risk premium went up to about 800 basis points because everybody was concerned the Eurozone is going to blow up. And since that, it has come down. And still, right now, we're talking about 400 basis points. Now, this is the critical assumption you have to make. I think right now, in the equilibrium, flat world, the steady state equity risk premium should be 300 basis points. So it should be riskier than before, than any of the previous decades. I give you 300 basis points. That, you add up another 300 basis points, 3% of terminal risk-free yield, give you 6%. That's supposed to be your steady state earnings yield for stocks. Actually, if you think about the junk yield, it's probably more or less in line with 6-7%. You invert that, you're talking about 16.7, let's say run it up to 17 times. Again, there's no science here. I'm just giving you my sort of a gut feel, intuitive answer. You can have your own calculations that the world is about to completely implode, so the equity risk premium should be 500 basis points. Well, we can make all sort of assumptions, but here, that is a critical issue. So you have to really spend some time to think about that in order to get a handle on the market evaluation story. But my feeling is, in a steady state, a flat world where there's no bust, no boom, we're talking about probably around 17 times. Today, the S&P 500 is trading about 15 times forward PE. So I would say probably in that world, the market should get a whole lot bubblier than it has been. In other words, you have to look for signs of building bubbles. You will have bubbles. So that's the second story I want to talk about. The third thing, the implication of this flat world is really this bull market is going to last quite some time. Here, I'm basically showing you this chart. If you look at the bottom panel there, that is the yield curve. It's a 10-year Treasury yield over Fed fund rate. If you look at recent history, every time you have to have an inverted yield curve in order to precipitate a recession. And we all know that a cyclical bear market in stocks almost always precede a recession. So basically that says you have to have an inverted yield curve in order to have a cyclical bear market in stocks. Now, if this story plays out correct, meaning the cycle turns very flat, then this yield curve is not going to get inverted for some time to come, right? Because the Fed is probably going to keep rate at about 0 for quite a number of years. Maybe slightly above 0, but I don't think it's going to be significantly higher than 0, because if there's no boom, there's no compelling reason for the Fed to nudge rate significantly higher than 0. So this curve is going to stay positively sloped, and then basically says the bull market could last quite a bit longer. I think I'm quickly running out of my time. I would go through bond market here. The whole world has turned very negative on bonds. I don't know whether there are any of our clients, BCA clients. I would assume there are probably a few. Actually, if you look at our research since December, well, since the fourth quarter of last year, our call on Treasury bond was neutral duration. Neutral duration is a call. We did not short bonds. The reason for that is that we think the world is still very much oversaved. The world is very much oversupplied. And I think in a deflationary world, the central bank has a lot of control over bond market. You don't want a short duration. Now, the market has rallied substantially. The prices have gone up quite a bit in terms of treasury markets. Now, what should we do today? That's always the question. You are as good as your last call. What should we do today? Now, look at the first panel here. The first panel is price. It's total return for 10-year treasury bond. It's basically 12 months rate of change in bond prices plus whatever treasury yield you're going to get. That's total return for bonds. As you can see here, we have had a pretty steep shakeout in the bond market last year. If you look at this chart, do you want to be short bonds? I don't. My guess is that bond yields are going to go to 2.3 to 2.2% before yields are moving back up. That is very dangerous. That chart tells you it's very dangerous to go short bonds right now because we had a very oversold bond market condition. And of course, not to mention that oversaving problem remains very acute around the world. Finally, I don't want to sort of get too complicated here. Finally, I have to comment on that because we had a poll just at the beginning. Majority of audience are taking a bullish view on emerging markets. My message here is be careful. If you look at the first panel here, this is emerging market relative performance. The emerging market relative to developed markets. The bottom panel here is trade-weighted dollar. You can see the negative correlation between the two being very close. And you have to make a bet on the dollar. I am bullish on the dollar. If you are bullish on the dollar, don't be too bullish on emerging markets. I think big chunk of emerging market is commodities, and dollar has a very strong influence on commodity prices. So I look at this thing, I don't want to be long just yet. Finally, this is always an interesting story to talk about. Every decade, as I said at the very beginning, I'm a simple man. I want a simple solution. If you look at around the world, the investment game could be incredibly simple. Every decade, there is one dominant macroeconomic story and one dominant trade. If you get that trade right, you become incredibly rich. It's not even funny. Okay? If you look at the 70s, what was the major macro story during that time? Well, it's the breakdown of the Bretton Woods system, driving down the dollar, driving up inflation. So anything has anything to do with inflation, you should own it. Gold and commodities, nothing else counted. That's a 70s story. And it's a 10-bagger. 80s, what was the major story? Was rising sun. It's Japan. Japan's going to take over the world. Japan is doing so incredibly well. It's going to be the only story in town. So 80s, you want to own Japan, unhedged. Again, it's a 10-bagger. Of course, you have to sell everything in 89. 90s, what was the macro story? Information technology, the information revolution, internet is going to change the world. The story you want to play, NASDAQ, nothing else. You just stay with NASDAQ. Again, you have to sell everything in 99 on time. You become incredibly rich, okay? Last decade, the story was very simple. The rise of China. The Chinese economy becomes so big, it's going to be very, very big. Again, the story you want to play, buy Chinese shares. You got a 10-bagger here. Okay? So I would say that emerging market commodities are all part of the China story. We know that. I mean, Chinese started to become so big, they got to use so much commodities, it cannot go anywhere but up. So that's part of the China story. This decade, people keep asking, when do I buy back emerging market? I said, you are looking at last decade's story. Move on. Find out something else. You're not going to get rewarded by playing last decade's story. So the question is, Chen, tell me what's this decade's story. I said, I don't know. The only thing I know is I'm looking at this. Everybody was so bearish on this biotech, this social network. I don't know I don't understand them. I don't know anything about it, but I'm just looking at the pricing behavior of that thing. It looked like a bubble in the making. And that bubble could go into a mania. So I don't want to short that thing. So the bottom line here is, move on. Look for new stories. Thank you very much.
No, you can stay here. You can also walk around. Yeah. So thank you very much, Mr. Zhao, for your very entertaining and interesting presentation. I would like to ask you, you made the point that the US stock market has some way to go up in terms of appreciation, in terms of valuation, higher PEs. How would you see the European stock market compared to the US stock market?
I think our key cause last year, since something like the summer of last year, we've massively overweight Eurozone, especially Eurozone peripherals. The reason is very simple, actually. Just give you an example. If you think about the peripherals, Greek market. I'm long that thing over my top. I'm still long it. The reason is this. If you think about this internal devaluation, they have delivered a massive internal devaluation. I just quoted some of the numbers, like 28% decline in real wage in Spain, 30% nominal contraction in Greece. These are all representing a huge internal devaluation. And then I look at, if you go back and look at the sort of average profile of a crisis-stricken country, look at their stock market, from crisis lows to recovery highs. The duration of that recovery phase is about 4 years. You are talking about 4 baggers. And then I checked the Greek market, for example. That's only one example, but to a certain extent it's true for all the peripherals. The Greek market, some of my clients said, Chen, the Greek market has already doubled. I said, yeah. And then I checked the chart, and it doesn't look like it's doubled. But actually what happened, the market had dropped about 98%. This is like a dollar become 2 cents. And from 2 cents, you double to 4 cents. Of course, you don't see that in the chart. That's what I'm saying. Internally devalued countries are becoming more competitive. Their asset prices have marked down quite dramatically. If you look at Spanish export growth, it has taken off, and it's actually literally soaring right now. So that's the reason you want to be long peripherals, still.
Mm-hmm. Fragen?
Yesterday we were given a rather dark outlook on China from Felix Zulauf based on overinvestment and capital misallocation and so on. Could you just elaborate a bit on that, how you view China and what's really going on?
Don't get me started on that. Don't get me started. But I'll respond. I think it's completely the mainstream media is so over-exaggerating the negatives. I think one of my contrarian thoughts is to buy Chinese banks. That's the time to do it, and the time is now, okay? Why? There are a couple of angles to think about the Chinese economy. Number one, the so-called overinvestment problem. I don't think they really know what they're talking about. The reason I'm saying that is, if you look at the Chinese economy, it saves 50%. 50%. Gross national savings rate is 50%. That's a good thing. Why? That has allowed the Chinese economy to invest, to completely self-finance the industrialization process. You're going to ask yourself, what is industrialization? Industrialization means a very simple thing. You have to increase your capital-labor ratio so that the farmers can be equipped with pieces of machine so that they stop digging dirt and stop making things. That's what the industrialization is all about. And the only way to do that is by investing. You can save enough in order to invest, to increase your capital stock, or you borrow. If you borrow, most of the country got into crisis. That's the little dirty secret the Chinese economy has had over the last 30 years. They have never borrowed a penny from abroad to finance the industrialization process. That is a good thing. Don't get it wrong. That's number one. Number two, you probably heard that the Chinese economy is grossly over-leveraged. They built up too much debt and is going to have a systemic problem. Wrong again. Why? That's why, don't get me started on this thing. Why? You're going to ask yourself, why debt occurs in the first place? Well, debt occurs because you have to convert savings into investment. That is a means of financial intermediation. It is financial intermediation through which national savings can be transformed into investment. Right? It has to be right. Ladies and gentlemen, it has to be right. This is basic economics. You can go through equity markets. U.S. basically used equity market to do the transformation. But U.S. has a very unique economy, got a very big and deep equity market. Nobody else can have that. That's why China, Japan, even Europe have to rely on banks, the borrowing market, in order to complete the transformation of savings into investment. If that is the case, then you have to agree that a country with a higher savings rate will have higher debt. As simple as that. Go and check private sector debt GDP ratios. The highest countries are Taiwanese economy, Hong Kong, Singapore, China. These are high savings economy because they've got a huge pool of national savings that needs to be intermediated into capital investment. Hello? Now, if you look at the Chinese economy, if you look at the breakdown of that debt level, it's oh, how come is my picture here?
Können wir die Präsentation
Okay, anyway.
nochmal? No, we will get it. Die Präsentation nochmal bitte.
Don't worry about it. So I basically give you a breakdown of that debt picture here in China. Here. Let's first look at the Chinese public sector. Everybody talking about Chinese public sector debt. The provincial debt is going through the roof. Total debt is about 50% of GDP have gone up very quickly. No question about that. But some of the strategists and researchers and even reporters, they are lying on one thing, which is this. When they talk about the U.S. public sector debt GDP ratio, they are talking about net debt to GDP. Net debt is gross debt taken out liquid assets. That's how you derive. That's IMF definition of net debt. It's gross debt taken out liquid assets. When you talk about U.S. public sector debt GDP ratio 90%, that's net debt. When they talk about the Chinese public sector debt, they immediately switch to gross debt. Why? If you do the same adjustment, i.e. if you take out the liquid assets that has been held by the Chinese government, that's the picture. You got a negative net debt GDP ratio. Look at this chart on your side. Okay? They cannot show that because that's That's not a scary picture. That's public sector. It's grossly under leveraged, I can say. Now, public sector, I'm not saying there's no problem. There's a lot of problem in China, but I'm saying some of the misleading information, you gotta keep that in mind. The next time you hear that, you're going to tell you are full of it. Why? If you look at the Chinese corporate sector, capital formation, 50% of capital formation in China is financed by retained earnings. Okay? You see the shaded area here? The shaded area represents retained earnings. This capital formation financed by retained earnings. The same comparable figure for the United States is 14%. Everybody understands one thing. If you have ever been to China, you would understand one thing, which is the private sector have huge problem to obtain loans. That's why they have to keep a large amount of profit as retained earnings so that they can finance their own operation. Okay? So the corporate sector, I don't think is over-leveraged at all. Now, the problem in China, I'm not saying there's no problem. There's lots of problems. There's a lot of serious problems, but not the problem that you and I keep reading about it from the newspapers. The problem here is the structure of the credit is completely suboptimal. Why? You basically have state-owned sectors producing 1/3 of the national output, but consuming 80% of credit. Whereas the private sector produces 2/3 of national output, but only consumes 1/3 of the credit. So there is a problem in terms of credit allocation. There's a problem of bad loans. There's a problem of property market going down. There's a problem of everything. But it is not a result of an over-leveraged economy. It is a typical problem that is associated with the economy that saves too much and invests too much. But be careful here. I don't buy the argument of the systemic risk at all. It's nonsense. I have never seen a country with such a huge amount of net assets, current account surplus, such a low level of government debt that have gone through systemic crisis. No goddamn way whatsoever. Sorry for my language. That's why I'm saying I don't want to get started on the thing.
Weitere Fragen?
Okay, we figured out, I think.
One question from my side. What do you think regarding the exchange rate from the euro to the dollar looking forward?
Well, that's a tough question. Let me give you my thought on currency in general. I don't want to take that position. I want to take some other position. I think the controlling call today, the controversial trade today, is to buy the Japanese yen. Why? And the short euro. Why? The whole world has been very negative on yen. If you ask 90%, if you ask portfolio or currency trader, 90% of them saying, well, the yen is going to go down. It's just a matter of time, whether it's 6 months or 12 months, it's going to go down. If you look at the market positioning, the currency market has been jammed with a huge backlog of yen shorts. Okay? That in itself will prevent yen from going down. That's from the market perspective. From economic perspective, is there any reason to be long the Japanese yen? Well, yeah. Don't get me wrong. I was trying to short the yen. I lost my shirt. And now I'm changing my idea. I think that, there's something wrong here. Is there any fundamental reason to be long the Japanese yen, the short euro? The reason is yes. If you look at PPP, purchasing power parity, the Japanese yen is about 40% undervalued against euro, about 25% undervalued against the dollar. The yen has become incredibly cheap. Why? Well, you got a 25% decline last year on top of 20 years of real depreciation through falling prices. So if you've been to Japan, you'd notice that. Things getting really cheap. So that's the first reason You don't want to be too short the Japanese yen. Number two, if you look at the policy stance, the Japanese economy seems to be moving out of deflation, whereas the Eurozone seems to be moving into price decline. So the sequence of things is that the Eurozone is slowly stepping into deflation and Japan is slowly stepping out of price deflation. That has a huge implication for policies. I think Bank of Japan, they have already done the QE, it's already in the market. It's already in the market, built in at the 25% gain, drop in the yen. That's all about the QEs. So I think my bet is that Bank of Japan may not do something until end of this year, maybe for a long time. Whereas the ECB's policy maneuver has not been discounted yet. Right now we're talking about 15 basis point, big deal, that's nothing. That's nothing. So they have to do QE, in my view, with a purpose of driving down the euro. So be long the yen, be short the euro. That would be my advice.
Thank you very much.
Thank you.